It's time to learn how to save and spend your money at the exact same time. I'm Jadu, this is Jonah. We're the Banking Bros, and here at the Cash Compound, we are cracking the code to cash flow. We're going to help you understand what the wealthy have known for 200 years in this country, and we're going to break it down with simple facts and figures to help you get on that same road as well.
Yeah. See, we've all been taught to lock our money up so we can't use it right away, or to give it some control to someone else so they have more access to it than we do. And of course, we've all been taught to take risks. After this presentation, you'll learn that we are teaching the exact opposite of those things. Keep control yourself, take absolutely no risk, and of course, don't lock your money away. So, are you ready to learn the save and spend system? Let's go.
Let's dive right in. I'm Jeremiah, once again, of the Cash Compound, one half of the Banking Bros. I'm going to walk you through the save and spend system, or how to become your own banker. Let's get right into it. A reminder that what we're teaching and preaching here comes from Becoming Your Own Banker from R. Nelson Nash, and this is the 5th edition. We're not making up anything that we're going to talk about here on this recording and this presentation. It is in this book right here. It's the field guide, and we suggest that you add this to your wealth building library. I've read it through many times. It's completely changed my life and help us recapture the dollars that leave our family through regular purchases, through financing, and through debts, all at the same time. I'm going to make you 2 promises here as we go through the save and spend system, and it's going to be, I'm going to teach you how to save and spend your money at the exact same time, and we'll show you how to recapture or recoup or get back all the dollars that you're going to be spending on things that you normally finance, like vehicles. Let's move through that here, and we're even going to help you pay off your debt utilizing this system. And we're going to unlock the infinite banking concept. One of my favorite quotes from Nelson Nash says that if you really know what's going on, you'll know what to do. So let's make sure you really know what's going on. We are talking about money and finances here. Now, money isn't everything, but it ranks up there with oxygen. And Zig Ziglar said it best there. There are many other things in the world and in life that are very important, but money is so important, we want to get it right. And more importantly, sometimes we just want to stop getting it so wrong. My name is Jeremiah Dew once again, and I've been practicing the infinite banking concept since 2016. I've got over a handful of policies at this point, and we've been helping people move through the infinite banking concept through the save and spend system. We're going to help you do the same thing. And we're going to make sure that we understand that many things that we think about money and we're doing with money right now are completely backwards. Now, I grew up in a family where the only thing we talked about when it came to money was, hey, we can't afford that. Money wasn't necessarily taboo in our house, but we didn't have enough of it to worry about that much anyway. So we're going to get it right now. We're going to change the trajectory of our family utilizing this system and your family moving forward. Let's define money before we get started for just 1 second here. Money is a means of exchange. If I can use that as a simple definition, we utilize the dollars to get the stuff we really want. So we don't really need the money in and of itself because we can't wear the money, we can't eat the money, and the money doesn't get us around to where we need to go. Money is the means of exchange to get the stuff that we really want and value in our life. So I'm going to set it up with the 4 C's here. Money is good for cuisine and cars and comfort and clothes. That's what the money is really good for. So we need to make sure we're putting our money, this valuable tool, in a very, very good place for us to be able to get to it quickly, where we can't lose it or it goes backwards, and it's not going to be subject to all sorts of problems. We just need to exchange it for the things that we really need. So let's put some money in the bank here. If you take a look on our picture, we've got a slide that says you've got $50,000 in a conventional savings account at the bank. And now this particular bank is allowing you to earn an annual interest rate of 4%. Now, some of you haven't seen that in many years, and some of you are thinking, wow, that's a pretty good system. And I agree. So 4% is how our money is growing just by sitting it in a bank. Now, I'm sure most of us put dollars in the bank now, and that's where they're residing. Now, when we need to utilize money, we normally need to pull things out of the bank with a withdrawal, or maybe we take a loan. So in this example, you've got a choice. You can either withdraw your $50,000 out of the bank, but then it, of course, will stop earning 4%. Or you can borrow money from the bank at 6%. Now, is anybody out there thinking that they should borrow money to purchase this car at 6% when you're only earning 4%. That may be a tough decision for some, but many of you, probably like myself, are thinking, no way, I would never borrow at a higher percentage than I'm earning because then I'll lose money. If you don't mind, we're just going to do the math together. We're going to come up with a term of 6 years or 72 months. During that time, we're going to end up paying $828.64 back to the bank in monthly payments for the use of their money. But of course, we can drive off the lot today. And while we do that, we're going to continue to pay for 6 years back to the bank. They're going to be earning during that time, and we end up with a future value of $59,662. Now, during that same amount of time where you've been driving around in your new car and you've paid $9,662 in interest payments above and beyond what you borrowed back to the banking establishment from which you borrowed the money, your money over the course of that same 72-month period earned and now totals $63,256. Now, why is that? These are two separate transactions completely from each other, but as you can see, by leaving your dollars in the bank, you have earned $13,256 in interest, and you've paid $9,662 back to the banking institution. You came out on top, and of course, you've got the car that you've been driving around for the last 6 years. Now, why is that? I dare say most people don't understand from where money is growing and who is it flowing to. The money has been flowing towards you in your savings account at the bank by earning 4%, constant compounding, uninterrupted this whole time. Meanwhile, you've done a separate transaction that cost you money, but you were paying down a decreasing balance. So over the course of this 6 years of time, you've paid less money in interest than you've earned. Very interesting to understand. Of course, if you had withdrawn your dollars from the bank, 6 years later, if you hadn't replaced those dollars, you'd have $0 left. Here's another fun fact that we need to go through. It's the guaranteed versus average. Now, many people are told to put their money all over the place in different things. And maybe there's growth, maybe there are averages, but let's take a look and see what happens to $10,000 over the course of a decade. You can see that our chart shows 4 different scenarios for 10 grand. A guaranteed scenario of 4% each year for a decade. Then we've got a loss in year 1 with a 20% loss in year 1 and then 6% for 9 years. Loss in year 5 shows 6% each and every year for 9 years, but in the middle there is a 20% loss. And the loss in year 10 says that for 9 straight years, we're earning 6% compounding interest, but in the last year, we have a loss of 20%. Now, as you look across the bottom, you've already figured out that the one that you're probably going to want over the course of your money being locked up in this system is going to be column 1, the guaranteed 4% each and every year, $14,802 at the end of this decade. And then the other 3 scenarios, it's interesting to see that despite earning 2% more, 6%, 9 years out of 10, you end up with less money than $14,802, and it doesn't seem to matter over the course of that 10 years when you lost the 20% at all, because at the end of your decade, you end up with $13,516 every single time in every scenario. Isn't that interesting? Now, let's talk about the drawdown effect for 1 second. And this helps us understand what happens to our principal balance when our money is up, when it's down. Maybe it's in the market. Maybe you've been taught to save for the long haul. And over the course of, 20, 30, 40 years, the market is going to come out at some sort of average like 7, 8, or 9%. But let's take a look and remind ourselves about the drawdown effect and what happens when we lose our principal. Let's say that we've got $1, and over the course of year 1, our losses total 10%. I'll give you a second to tell me or to think how much money you have now at the beginning of year 2. The answer is obviously 90 cents. We've lost 10% of what we had. And now, to start year 2, we have a much better upturn in the market, and we have a 10% gain. Now, how much money will we end with after the second year? If you said 99 cents, you're correct. And why is that? Because we've started from a lower balance. We've got 90 cents at the beginning of year 2. 10% of that would be 9. And so if we add 9 to 90 cents, we have 99 cents. If you're thinking that we'd be back to where we started, what you missed is the drawdown effect. We're starting from a lower principal balance, and therefore we have to earn more than we lost to get back to where we started. The gain needed to break even, as you can see in this chart here, is going to be 11.1% to go back to the $1. So we need to think about that quite a bit when we're talking about the fluctuation of our dollars in the market or other places. If we lose 50% in year 1, we'd have to gain 100% or double our money in year 2 to get back to where we started, or the gain needed to break even. But what's interesting about that particular scenario is, let's think about the averages. We hear so often about market averages, or averages over the long haul, or averages ever since the stock market crash of 1929. Let's see what the average is between negative 50% return and a 100% return. If we think back to high school, we remind ourselves that we're going to have to add these two numbers together and then divide by how many numbers we have. Negative 50 plus 100 is positive 50. Divided by two numbers is 25%. So over the course of this scenario, we've had a 25% positive rate of return. But a reminder, did we make any money? The answer is no. We gained enough to break even. We got back to where we started. But if someone is telling you, or the market is telling you, that there's a 25% average rate of return over the course of that time, we've got to realize that we may not have made anything. Now, were there taxes during those few years? I bet there were. Was there inflation and the value of your dollars went down? I bet there were. And wouldn't it have been nice to be able to use those dollars during that time and not have them locked up? I bet it would have been great. Now, what if you needed to use the dollars after year 1? Or maybe after year 1, that was your retirement date. Well, as you can see, during that time, you would have been down and you would have needed to use the money, and it wouldn't have been able to get you that same return if you were going to use up that principal. It's very interesting for us to consider these questions. Is a dollar worth more today or in the future? Well, because of inflation, and of course, the number of candy bars you can buy at the store, you probably realize that dollars are the strongest they're ever going to be right now. They're worth more today. Are taxes going up or down? Now, this one is an opinion question, and I can't factually tell the future. But if you know about historic tax brackets and environments, we are in a very low bracket and environment right now. Taxes have been much higher on a federal level in the past, much, much higher, up to 3 times as high as they are at the time of this recording. So if you think that a government that is over $30 trillion in debt and is currently blessing us, if I can say it that way, with a low tax environment, I have a feeling that taxes are going to rise over the course of my lifetime and yours. What do you think? Now, would you rather pay taxes on the seed or on the harvest? Would you rather pay taxes today on the small amount or later on the large amount? Remember, in the future, we probably both agree that we're in an unknown tax environment, and that tax environment's probably going to be higher. My guess is you're going to go with me and pick the seed. I'd rather pay taxes on a known amount today. Well, what's interesting about this, for those of my friends out there watching, listening, and learning, I think most of the working Americans have been duped into putting their dollars into environments where we're not able to actually follow through on these ideas. If you're participating in a qualified plan, ladies and gentlemen, under my voice, you are violating all 3 of the questions that we just went through. Your dollars are in environments where you cannot get to them, and they're going down in value. Taxes will always be there at the end of those terms, or maybe when you turn 59 and a half, and you'll be taxed on larger portions or on more things, even if taxes don't go up. Why do we do things with money that we'd never do with the things that money can buy? Reminder again that money is just a means of exchange. It helps us get the things that we actually want, like cars, cuisine, comforts, and clothes. And now we've got all of those things locked up in environments where we can't utilize them and we can't eat them and we can't drive around in them. And I don't think anybody out there would actually take their money, buy cars with it or clothes, and then not drive around in those cars or wear those clothes until we got retired. Would you rather? We've got $1 million on our left. And on the right side of the screen, we've got a penny that doubles every day for 30 days. Which one of these two scenarios would you want? If you said $1 million, you'd be very much like me the first time that I saw this. How in the world could a penny surpass $1 million after just 30 days? Well, let's take a look. As you can see on this chart here, we go from 1 to 2 to 4 to 8 cents each and every day, and we've got $1 million on standby for those of you who decided to go for the $1 million today. Now, after halfway through the month, we take a look down at day 15, and we're at $163.84. And on the right side, we kind of start to realize the power and strength of constant compounding. By day 28, the penny has turned into 1.3 million plus, 2.6 million plus after 29 days, and a whopping $5.368 million after 30 days. If you picked the penny, you're right on track. And the reason that folks like myself weren't able to get this question right and understand the strength of constant compounding is because we've consistently placed our money in environments that didn't have constant compounding, and we didn't know how strong it was. Now, Albert Einstein, maybe the smartest man that we could come up with and think of, said compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Let's figure out what happened to all of us out there who were just paying it rather than earning it. We placed our money in environments with fees. Now, our uninterrupted compounding penny actually had a 2% fee added to it. Now, this could be a brokerage fee, an account fee, or maybe in our house, our favorite is just overdraft fees. Whatever that might be, you can see that because a 2% fee was added to our $5.3 million total, we have now lost more than $2 million. It just wasn't there to compound. What about withdrawals? Of course, money is just a means of exchange, and we need to utilize that money to buy stuff and get stuff that we really want and need. So if we pull $100 out on day 15 and go from $163 down to $63.84, and then pull another $100 out on day 25, look what happened to our $5.3 million. A $200 withdrawal cost us $3.28 million because it just wasn't there to compound. What about a 15% tax? There's all sorts of types of taxes, and we have added a 15% tax to our dollars. You can see we don't make it to 2 cents until day 5. Well, that's going to have a big effect on our finishing number. We paid $182,000 in taxes. However, that tax caused us a loss of $4.8 million. It just wasn't there to double. And we end up on day 30, instead of $5.3 million, with $559,000. Now, what if you could place your dollars in an environment with constant compounding and were not subject to taxes, to fees, or withdrawals? Would you want to know where you could save your money? Now, let's talk about banks. One of the most powerful institutions in our world today. And let me show you why with a visual. Now, we're going to place money in this bank just like we did a little bit earlier. If $100,000, like my money and yours, ends up in this bank, we'd probably do that because of safekeeping and some of the perks that banks offer. Of course, there's online bill pay and there's many other things. But historically, it was all about the interest. If you'd save your money with a banking institution, a conventional bank on the corner, they would offer you interest. So in this scenario, there's a 4% interest that is going to be earned annually on the dollars that we leave there. Now, the bank has a liability on their hands, and they need to send loans out into the marketplace. The bank owes you services, and of course, they owe you $4,000 at this point. So what do? They turn around and they loan the money out. Banks are in the business of lending. And when they lend to the person right behind you in line at the bank, they're going to put some spread on that. See, they're going to charge that person, and that becomes an asset to the bank. So the bank is going to loan out dollars to me and to your neighbors for things like homes and houses. So when they do that, that person is going to give the money right back to the bank via the seller. Of course, the seller is going to take those dollars and they're going to deposit it right back in the banking institution. And of course, the borrower now owes dollars back to the bank each and every month. But the bank has got their second deposit on their hands. And the bank, of course, looks at that as a liability, and they're going to loan it out to the next person. For a car, that money keeps on moving, goes to the car dealer, and ends up right back into the banking system. At this point, the bank knows the drill, and they've got to find someone to loan and lend the money to. So how about 9% on a home remodel? Goes to the contractor, who in turn puts the money back in the system, and then right back out for a debt consolidation and credit cards. Those dollars end up right back into the banking system. Now, over the course of time and the year, you can see that the entity in control of the movement of money in your town and mine is the bank. Now, the bank was not using their own money. They used your deposit to move around. And because it was your money, and of course there was paperwork done at every exchange and every loan, you can see that the bank took very little risk. And of course they offset the risk by the interest rate that they charged. You've probably heard of the golden rule. Whoever has the gold makes the rules. So now at the end of time, let's have a simple explanation of the money that the bank made. Because there was a spread between the 4% owed and the 7% made on the home loan, the bank was able to make 3%. Then they kept the money moving, and once again, 4 and 8 allowed the bank to make some money. On top of what they were guaranteed to pay you, there was 4% left over. Once again, 9 and 4 would be 5 for the bank, and 12 and 4 would be 8 for the bank. Now, all these separate transactions added up, 3 plus 4 plus 5 plus 8, would mean that the bank made 20% on your money while you made your 4. 20% is extra. And the question here would be, how much more percent did the bank make than you? Now, if you said anywhere near 500%, you'd be correct. And the reason for that, of course, is that 20% is 5 times 4%. Now, I was under the impression that it was going to be something more like 16%. But we've got to remember that $4,000 and $20,000 has a 500% difference. And so the bank was able to keep all that profit on top of the money that they were able to give you, and now they have made money. This is the first time that the bank now has money at the end of these transactions. Now, the bank did not use their own money. The bank did not take any risk, and the bank had control of this entire scenario. The only interesting thing to think about here is, did the bank buy anything? Or did the bank use your money, and did you and I buy all the things? The only thing missing from this scenario is that we were not the bank. It was all the stuff that we bought, we needed, we wanted, and of course it was our dollars, but we just did not control the banking function in our own life. And if we did, we of course could profit off of the debts, the expenses, and all the wants and wishes that we want. We've all been taught to lock our money up and give it to some other third-party institution. And they've promised things like compound interest to us, but do they leave the money sitting around and locked up? Of course not. Money won't multiply unless it's on the move. So we've also been taught to give up control of the dollars and give it off to third parties and let them deal with it and let them have the potential profit while we take all the risk. Well, what if you didn't have to do those 3 things with your money? The ideal asset to utilize for constant compounding, no issues with taxes, fees, or withdrawals, and of course, full control is a dividend-paying whole life insurance policy from a mutual company. Now, when I first heard this almost a decade ago, it completely blew my mind. And I said, I thought we were talking about wealth building, the save and spend system. And now we're talking about insurance. I'm confused. I don't want to die. I thought we were going to live and buy things. Well, the reason that we're going to utilize dividend-paying whole life insurance from a mutual company is because the wealthy have done this in this country for 200 years. It's not on trial. These are guaranteed contracts, and they work every time. They are a lot more like banking systems than they are the traditional way that most of us think about life insurance. And your bank, one of the most profitable enterprises on the planet and in your town, owns more dividend-paying whole life insurance than their land and real estate assets combined. So how are we going to do it? We're going to do it just like them, and we'll walk you through in the second half of this presentation. Don't get it twisted. Whole life insurance from mutual companies is the ideal asset because of its growth, its guarantees, its liquidity, and its privacy, and we're going to be able to save and spend money at the exact same time from this system. This method has been in play for over 200 years in this country, since before the Civil War, and many business magnates have used dividend-paying whole life insurance policies from mutual companies for their banking needs, to finance businesses, to pass on legacies to their family, to eliminate taxes, and to keep their wealth in their family. We're going to show you how. Reminder that BOLI, bank-owned life insurance, is a very common practice in our country, and by looking up your bank at usbanklocations.com, you can see the billions and billions of dollars of whole life insurance policies that are owned by the major banks in this country. So the question just might be, are the banks doing something ridiculous and dumb, or perhaps the wealthiest families and businesses in this country, do they just know something you are yet to understand? Reminder that there are many types of life insurance in the world, and we've specifically said dividend-paying whole life insurance from mutual companies. So when we think of term products, temporary insurance on your life that expire, or the various types of universal life insurance products, we're not talking about those products because, one, they did not exist over the course of 200 years, and two, your bank and the wealthiest families in this country have not owned them or utilized them for banking systems. It's very important to understand that we are going to design whole life insurance policies that participate with the profits of the mutual company on purpose for the use of cash value and money to be spent so you can become your own banker, and we're not going to be utilizing the products that you see here on this screen. Make sure you work with an authorized infinite banking practitioner like the Cash Compound to be able to move forward with the right style of policy built for your banking needs. Let's talk about it in terms of the 3-cup setup. The product of whole life insurance that participates with a mutual company can be broken down into the 3-cup setup. The red cup, cup 1 for premium deposit, where we deposit our dollars when we give it to an insurance company. Premium buys insurance. It buys a pool of money or a policy or a bunch of paperwork or peace of mind. You can think of it in all those terms, and in whole life insurance, we are talking about death benefit. Now, how long do you think whole life insurance lasts? If you answered your whole life, you'd be correct. It doesn't matter if you die tomorrow or you die at you're 105 or 115 years old, the policy must pay out, and the insurance company knew that day one when you gave them premium. That premium deposit, like we like to say, so we can think of it like a bank, is now guaranteeing a payout one day for your family, friends, church, and charities. It must pay out, and it's income tax-free. Cash value, cup number 2, the green one in the middle, helps us and reminds us to see the net now of the future gross benefit. The death benefit is for the future, and it will pay out one day. And every day that you live, and the more that you pay premium, there is more and more equity inside your policy. Cash value is simply how much equity, if we can use that word, you have to be able to leverage the death benefit the insurance company owes you anyway. So we're going to show you how you can utilize this insurance company's money, the cash value, the net now, of the future gross death benefit later, while your money, premium deposit, stays put. If we decide to leverage and borrow against our policy, we are going to be able to use, lose, or abuse those dollars in any way we wish because the insurance company owes us the death benefit anyway. While our dollars are borrowed against our policy, we've got a lien or loan against our death benefit. And if we choose, like a bank would, to lend those dollars and receive them back, we are going to be able to replenish the insurance company's net now or cash value equity we have in our policy to replenish our death benefit. But notice the premium deposit, the dollars that we put inside this policy were never bothered. And those dollars have guarantees. Number one, they're a level premium, and the premiums don't go up or get more expensive as we age. Number two, they're guaranteed to buy a death benefit, and they must pay out. Number three, they don't go backward. They're not invested in anything. We've bought insurance. So as we repay the loan back to the insurance company, it replenishes what they owe us, and it's liquid again for us to be able to use for more purchases. And then should we decide to become our own good banker, an honest banker, we'd be repaying that loan with interest. Now, that's our money that we put in on top of the money that we borrowed from the insurance company. And as we do that, premium deposit or extra interest that we've charged ourselves buys more death benefit and therefore gives us more liquid and usable cash value. We also mentioned that we're utilizing dividend-paying or participating policies from mutual companies. Participating policies participate in the profits of the company because mutual companies have no traditional ownership and they don't trade stocks on the exchange. So at the end of the year, all lines of business and the general fund and portfolio of that company earns money. And on top of the guarantees in your policy, those profits can be shared with the policy owners. And we're going to choose, in most cases, to have them share our dividends or our profits as a partner with us in our premium deposit cup number one, because I like money with my money. So premium deposit goes in, it buys more death benefit, of course, therefore giving us more liquid and usable cash value to be able to utilize. If we understand what's really going on in the product of whole life insurance by way of the visuals of the 3-cup setup, we'll know exactly what to do.
I'll take it from here, Jeremiah. My name's Jonah, and I am the other banking bro, one of the coaches here at the Cash Compound. And since 2017, I've been helping folks just like you implement and practice the infinite banking concept. The reason that I'm jumping in now to finish out this presentation is because we get to talk about implementation, about how exactly to save money and spend money at the same time, and how to make purchases and get all that money back and keep the purchase, like possibly a car, like Jeremiah mentioned earlier. Jeremiah likes to talk about some of the older faces that have been using the infinite banking concept, but since I'm all about implementation, sometimes I like to talk about some of the newer faces. So I listed 5 of them here on the screen, and I'll tell you just a little bit about each of them. First is Jim Harbaugh, the coach of Michigan football, recently actually promoted to the NFL, but there's an entire ESPN article about how Michigan football paid Jim Harbaugh from a whole life insurance policy from a mutual company that pays dividends. Sam Walton, the owner and founder of the Walmart Corporation, actually offered infinite banking policies and plans to each employee that signed up for their employee benefits up until about 1988. He ended up getting in trouble for doing this because he neglected to tell those employees he was doing it. You've more than likely heard of Joe Biden, our current president, but of course, because infinite banking policies are private, he doesn't have to disclose how much or how many infinite banking policies he has. We just know that he absolutely does have them. Doris Christopher was the founder of Pampered Chef, a basket making or kitchenware making company who actually recently sold to Warren Buffett. And of course, the number one user of whole life insurance policy is your everyday bank. Now, before we get into using your policy contract for vehicle purchases, I want to walk you through 2 things that most people know about insurance. And I want to knock them out of the way early so we can focus on using the insurance as an actual private bank, as opposed to just the everyday natural insurance policy that you know about. And those 2 things are age and death benefit. And here's what I mean. If a 20-year-old and a 40-year-old go to get life insurance, which one gets the most death benefit? You probably answered correctly at home. It's the 20-year-old. They're younger. Now, if a 40-year-old smoker and a 40-year-old non-smoker go to get life insurance, which one of those two gets the most death benefit? Of course, it's the 40-year-old non-smoker because they're a little bit healthier. So you already know that age absolutely plays a part in death benefit use. And of course, so does health. But watch this. If a 20-year-old, a 40-year-old, and a 60-year-old all go to the same grocery store and they're all carrying $20, who actually buys the most groceries? Well, they all buy the same amount of groceries because it's all about the $20. $20 is $20. Cash is cash. And that's what we're here to talk about when we talk about using the policy. So here's what will happen. In the third column, you'll see this labeled policy premium deposit. This particular policy was set up by a gentleman who wanted to deposit $2,000 a month into his policy. That's $24,000 a year. And as soon as he does that, right in the first year, he is purchasing $596,000 worth of death benefit. Now, of that death benefit, $13,921 is available for this gentleman to use. Now, he doesn't use it in this example. In real life, you are absolutely available to use it. You can access cash value immediately. In this particular example, this gentleman wanted to accumulate the cash value so he could use it later on down the road to make a bigger purchase. So the second year goes by, another $24,000 deposit, $638,000 available to him or his family, church, charity after he's gone, and his current cash value, the equity available for him to use, $28,386. In the third year, $24,000 in, death benefit has risen again to $681,000, and his cash value available is $50,858. Now he's accumulated enough money inside his policy where he is ready to use it. And so he does. He takes a $50,000 policy loan and he goes to purchase his car. To be clear, that means he takes the money from his policy, it's deposited into his normal bank account, he drives himself down to the car lot or gets a ride, he purchases his new car and drives home in the new car. Now, he's just taken a loan from his private bank. And he thinks to himself, well, if I would have taken a loan from any other bank, the bank would have forced me into repayments, no questions asked. Now here, I'm not forced into repayments, but maybe I should repay. Why? Well, because if I don't repay, it's kind of like saying the bank's money is more important than my money, and I don't like that. So maybe I'll repay. This gentleman decides to repay $10,200 a year, which is a 7% car note for all those folks at home that are doing math. So that's what he decides to do. $10,200 every single year, and he'll do that for 6 years running. So you can kind of see the example that we've got here on the screen. In the fourth year, another $24,000 deposit. Death benefit increases to $724,000, and equity available of that death benefit, cash value ready to go, $34,000. Now, he also is repaying himself $10,200 for the entirety of the next 6 years. Now, something unique happens in the sixth year, and that's his policy premium deposit actually drops to $9,600. Now, this is important. A lot of you at home might be thinking, my goodness, $2,000 a month, $24,000 a year, how can this guy do it? But when we think about this money in terms of a deposit, it should make a lot more sense to you. Most of us right now deposit much more than this into our everyday conventional banks. Think about your paychecks, whether they come weekly or biweekly, whether you get commission checks or bonus checks, tax refunds or Christmas presents. We deposit so much more into our everyday bank accounts than this gentleman is doing into his private bank. But in order to maintain what he's already set up for most of his life, he decided to only deposit $2,000 a month into his private bank. And after 5 years, he also decided to decrease his deposits. He could have kept his deposit the same, but he decided to decrease. Maybe life got crazy. Maybe someone got sick. Maybe the kids needed to go to the doctor or new school or whatever. But he decided to decrease his deposits. That's absolutely acceptable. So instead of $2,000 a month, $24,000 a year, he's down to $9,600 a year. The important thing to understand about even decreasing your deposit is to take a look at the death benefit number. That value keeps increasing each and every year. And so even after he's lowered his premium deposit, everything is still increasing about his cash value and his death benefit. A big, big deal. Let's take a look now at his net injection. What is happening after the first 8 years of his policy? So he's deposited in total $148,800. Feel free to check me on the math if you'd like. He also took out $50,000 to purchase a vehicle, and he repaid himself, not forced to, but he decided to repay himself $61,200. That leaves him with a total net injection of $160,000, meaning everything out of his pocket was $160,000. Now, 8 years later, let's take a look at his cash value. That's in the 8th row. In the 6th column, we'll take a look at cash value available. It says $132,603. That means of the $160,000 net injection, $132,603 is still available to him that he can access immediately. And of course, don't forget, he still has the $50,000 car. It's still his. It's in his driveway. He can drive it. He can sell it. He can trade it. He can give it to the kids or someone else, donate it. But it's his, and it's been paid for the last 6 years. Now, here's where it gets fun. Cars don't last forever, right? Sometimes you have to get new ones. Sometimes you want to buy the spouse one or someone else. So let's buy another car. Now, here's my question for you. If you have $132,000 sitting in a private bank, ready to be used at any moment, would you go down the street to your local conventional bank to get the new car loan? Probably not. Probably you use your private bank. So that's where we're going to take the next $55,000 to purchase the vehicle from the $132,000 that we had previously. Now, remember, his premium deposit in the 3rd column has adjusted and changed. He's dropped it from $24,000 to $9,600. But of course, the same principles still apply. Every premium deposit purchases death benefit, more of it. And of that death benefit, cash value available is the equity or present value that you could use today. He used $55,000 of it to pay for his new car, so he decides to repay himself 7%, like he did last time, over 6 years. That's $11,250 each and every year. So he does that for the next 6 years. Let's take a look at the net injection after this 6-year stretch. His policy premium deposit, or as much money as he's deposited into his private bank, is just $57,600. Think about that. In 6 years' time, $57,000 deposit. Most of us can do that in half the year, right? If not a quarter of the year, or even less than that. This gentleman did it over 6 years. $55,000 is what he took out to purchase the vehicle, and he repaid himself, just like any bank would force him into, $67,500. Now, he wasn't forced here, but he decided to do it. His total net injection over this 6-year stretch is $70,100, but his cash value is $218,329, meaning his cash value grew by $85,726. Now, I don't know about you, but how do we like buying cars using your own private bank? Did we not just purchase that car and actually increase the value of our private bank? Not to mention, we have 2 paid-for cars in our driveway now. One of them's 12 years old, and one of them's 6 years old. You could still have them. You could still drive them if you like to, but you could also give them away, donate them, or do anything else you'd like with them. And the increase in cash value inside your policy. That's the power of infinite banking. Now, you might be wondering to yourself, what in the world just happened? How in the world did our cash value grow by $85,000 and we made a purchase and kept a car? What in the world just happened? And we've found a very easy way to illustrate that is with the next 3 graphs. See, instead of being a debtor, going into debt to purchase the car, and then working our way back out of debt to a 0 line, and then being in debt to purchase the home, and then working our way back out of debt to be to that 0 line or purchase the vacation. And also, as opposed to being a saver who saves up the money to purchase the car and then purchases the car and goes back to 0, saves up the money to purchase the house and then purchases the house and goes back to 0, we decided to be a banker, an infinite banker. And anytime that you make purchases inside of your infinite banking policy, because the money that facilitates those purchases comes from cash value and not from your direct deposit into the policy, the value of your policy continues to grow, continues to get bigger each and every month, each and every year as your policy continues. And even though you're taking loans and repaying those loans, the principal value of your policy continues to increase. That's what happened. What we'll do now is take a look at our money map. It's a debt payoff example for all of you at home who are thinking, man, it must be really nice to be able to purchase cars, but I've got bills and I've got stuff to pay. This is actually one of my favorite examples because it can show you how powerful it is to actually use your policy and apply it for eliminating debt. So this particular example is real life again, and it's a gentleman who had $434,000 worth of debt. And he decided to deposit into his infinite banking policy, his private bank, $2,500 each and every month, which of course is $30,000 a year. Now, here are his actual debts. We won't list his name, but here are his actual debts. He owed $2,900 to his Visa card, $3,400 to his Discover, $5,000 to the dentist, $7,400 to Home Depot, $15,000 to Best Buy, $16,000 to Apple, $21,000 to Rooms to Go, $45,000 on a vehicle, Mercedes, and $316,000 on his house. If you add all that up, it's $434,000. Next to each of those debts and underneath them, I also have the monthly minimum amount he was required to pay, the interest rate, and how many months he would still own and have that debt if he just continues to do it their way. Now, I'll spoil it for you just a little bit. We're going to go a little faster than it would traditionally take him. If you take a look at the home, the deed at the very last debt, you can see that he's got 240 months left on that. And I'll give you a hint, that's just a little bit more than a few years. But we're going to go a little faster, and I want you to show how we did it. It's very important to realize that we're not doing anything different than what you do every day at your home. We're not going to do anything different but make deposits into our own private bank. You make deposits right now into your conventional bank. We're going to take loans, and if we take loans, we're going to repay them. Let me show you how we get this done. So there's lots of numbers on the screen, but I want you to focus on the right side of the page here. In the very first year of his policy, he deposits $30,000 into it, and his policy loan immediately available to him, is $17,401. And of course, with $17,401 available and someone who wants to pay off bills, he decided to do exactly that. So he pays off the Visa card, he pays off the Discover card, and he pays off the dentist. Now, Home Depot did get a little bit of an extra payment, but it didn't pay off right then. Because of the bigger payment, it actually does end up paying off before the year is over. And then he thought to himself, you know what? I just took a loan from my private bank, but actually I don't feel like repaying. And he calls me and he says, Jonah, thanks so much for helping me set up my policy. I took the loan. I paid off 3 bills. I'm feeling really great about it, but I don't want to repay. Is that okay? And of course I told him, sure, that's okay. You don't have to repay, but you could repay if you wanted to. Not only that, we just freed up money every single month. Instead of giving Visa and Discover $75 a month, that's now back in your budget. And if you wanted to, you could take that same money that used to go to those third parties and you could repay that into your policy. And he said, okay, sure, I'll do that, but I won't do any more. I'll just do what was promised to the old third parties. I'll put that back in my policy. I said, great. So that's what he's going to do as a loan repayment as we move forward throughout this payoff plan. At the end of the first year, here are his debts. Here's what he's got left. The 4 things paid off. Again, Home Depot did not pay off right away, but did pay off throughout the course of the year. So at the end of the first year, he's got 5 debts left. At the start of the second year, he puts in another $30,000 deposit into his private bank. His policy loan is $18,000, and he had repaid himself $32,000 throughout the course of that first year, which makes his total $21,000 that he can use to go ahead and pay off bills. So he does. Best Buy gets paid off, and Apple gets a little bit of a bigger payment, but does not pay off right away. Now, since he paid off Best Buy, he says, well, I used to give them about $250 a month. Now I'll decide to use that as my loan repayment. I'll keep that now, put it back in my private bank as a loan repayment, and be able to use that money later. So at the end of the second year, here are his new balances. The start of the third year, he puts in $30,000, and his policy loan is now $28,277, readily available for him to use. He also had accumulated $7,900 as loan repayment. So he's got a total of $36,000 that he can use to eliminate his debt. So Apple goes, Rooms to Go also is gone. His Mercedes-Benz gets a little bit of a bigger payment, but it doesn't pay off right away. Now, all he has left at the end of 3 years, 36 months, is his car and his house. So let's take a quick break to do a little bit of math. Let me ask, how much did we put in? Well, in the first year it was 30, the second year was 30, the third year was 30. That's a total of $90,000. And how much did we take out? What were his loans? We've got $17,000 the first year, $18,000 the second year, and a big jump in the third year, $28,000. That's a total of $63,000. So the question I have for you is how much is left in his private bank? Now, some of you might be doing math here. You might be taking $90,000 and subtracting $63,000. If you're doing that, I need to remind you that actually is incorrect. And the reason it's incorrect is because you have to think back to our 3-cup setup. See, $90,000 is in cup 1, his deposit, his premium deposit cup. And when you pay $90,000 in premium deposits over 3 years, it purchases a significant amount of death benefit. Now, in this example of debt payoff, we didn't show you that death benefit. But what we have showed you is the cash value, the present value of the death benefit that he could use, which is $63,000. So how much is left in our private bank? All $90,000 is left, and it's still earning for us. And after time, just like you would think with any type of deposit that is earning compound or constant interest year after year, well, look what happens. See, his premium deposit in the 4th year is $30,000, but his policy loan available is $30,101, more than he actually deposited. Not to mention, he saved up or accumulated $13,716 over the course of this last year for a total of $43,817 that is his and readily available for him to use to accomplish his debt payoff. So, bye-bye to the Mercedes. And all we've got left is the home. The home gets a pretty significant payment here in month 37, but it does not pay off. He's got about $247,000 left on that house note after that big payment. Now, fast forward just a little bit because all we have left is the house. And in the 61st month, 73rd month, and 82nd month, the home gets $32,000, $33,000, and then $19,000 to finish it off and pay that home completely to zero. So what that means is in exactly 82 months, 6 years and some change, every single debt is paid in full. Now, let me be clear. All of this money did not come from policy loans. A lot of it was from his loan repayment. All of those other debts that he had eliminated that now he could decide what he wanted to do with the money, and he decided to use it to repay his policy loans and build his policy back up. Every single debt's paid in full after 82 months. How do you think that this gentleman was feeling? How would you feel if instead of taking almost 240 months to eliminate debt, like the home, we did it in 82? The best part about the situation is that his private bank is built inside a whole life policy. And after 6 years, his whole life was still continuing. And so what he was able to do is use that money in any capacity he wanted now because his debts were paid off. Warren Buffett has this quote: "If poor people would just do what rich people do, they wouldn't be poor anymore." I love the quote. Now, the first time I heard it, I hated the quote because I thought to myself, Warren, come on now, you're picking on us. But the more that I read it, the more that I understood it, the more that I realized this system of infinite banking has been around for a long time. And I just need to copy what the rich would do in order to be just like them. This last tool that I'll show you is called the cash flow analysis. It's actually just a summary of your policy illustration. It's a summary of the policy illustration we just saw the gentleman use to pay off his debt. I'll prove it to you. See, underneath the red heading, premium deposit, we have exactly what this gentleman agreed to with his policy design from the get-go. $30,000 as premium deposit going into his private bank each and every year. And then after 10 years, he decided he wanted to drop it to $12,000. Now, every time he made that premium deposit, the blue cup, our death benefit, increased. You can see it start at $745,000, and by the time we're down to year 15, we're at $1.1 million. In the green cup, you'll notice that it's guaranteed cash flow each and every year that he can have this money. And you'll see that number start to increase as well. $17,000, $27,000, $28,000, $29,000, $30,000, just like the money we were using. Not only that, but we always use companies that pay dividends. And the two examples that we showed you today had those dividends included. And so the projected cash value is actually more realistic on what the company actually believes that they will do for you over and above what is guaranteed to you. And so we show that to you as well. The important part about the cash flow analysis is that when you start your policy, not only will we be more than happy to walk you through your cash flow analysis and policy illustration, but of course, after you get started, we'll walk you through this as well so you know what to budget around. You know what you can count on guaranteed, so that way you can accomplish your goals, whether that be saving and spending at the same time for debt payoff or for new purchases or investments, or it just be planning for the future, maybe for kids' college or retirement or something like that.
So are you ready to get started? It's time to schedule your cash consultation. It's free, and it's time for you to get your questions answered about doing this process for yourself.
We've got lots of coaches who are ready to take your call, who have all been practicing the infinite banking concept themselves, just like we have for almost a decade. So if you're ready to get started or need to understand more, please book a call with us. We'd be more than happy to chat with you.